If you are investing in mutual funds, be it for your retirement planning, for your long term goals, or for your child's future, then this new rule by SEBI is something that you should not ignore. SEBI has introduced a completely new category called life cycle funds, and at the same time, it has decided to discontinue the old solution oriented mutual funds. Most investors don't even know that this change has happened. But this update can affect your financial goal funds and the future mutual funds that launches in India. This is not just a small rule change. This is a part of bigger shift that how mutual funds will work in India. In this video, we will clearly understand why SEBI has changed this rule. What are life cycle funds? What happens to the existing retirement fund? And what you as an investor should know. Watch this video till the end very carefully because this change can affect your investments for years. Namaste friend, I'm Rohini and you're watching the knowledge series of Fincash.com. India's mutual fund industry has grown rapidly. Today, crores of investors invest through SIP and the industry manages lakhs and crores of rupees in assets. With this growth, SEBI's responsibility also increases. The role is not just to regulate market, but also to make sure that investors are protected, products are transparent, and the schemes are easy to understand. In the past, SEBI had already done a big reform in 2017 when mutual fund categories were standardized. But over time, some categories started creating confusion. One of the biggest issues was with solution-oriented funds. These funds were meant for long-term goals, but in reality, they did not always behave like goal-based funds. And that is why SEBI has now introduced a new structure. Solution-oriented funds were designed for specific purposes, like for retirement plan, long-term savings, child's future education. These funds usually had minimum lock-in period, limited flexibility, fixed investment style. The idea was good, but the execution was not always consistent. Different fund houses managed these funds differently. Some had high equity exposure, some had low equity exposure, some did not reduce risk as the goal came closer. So investors believed that these were safe long-term funds, but the risk level was not always aligned with the goal. So for new investors, this always created a confusion, and that is why the regulators want to cut down this confusion. To solve this problem, Life Cycle Fund is launched. These funds are designed for goal-based investing, where investment strategy automatically changes as the goal comes closer. The idea is very simple. When you're young, you take more risk, so the fund keeps higher allocation in equity. As you move closer to your goal, the fund gradually reduces risk and increases allocation in safer assets like debt. This gradual change over asset allocation is called glide path approach. In simple words, the fund automatically shifts from high risk to low risk investment as time passes. This concept is already very popular globally. For example, large international asset management companies like Vanguard Group, which is one of the world's biggest mutual fund providers, have been offering target date funds or life cycle funds for many years. In these funds, investors choose a target year, like retirement year, and the fund automatically adjusts the asset allocation as that year approaches. Now, SEBI wants to bring a similar discipline structure in India so that investors do not have to manually change their allocation every few years. This investment strategy automatically makes emotional less, more strategic and disciplined way for long-term investing. Under the new framework, life cycle funds have defined time horizon. They have automatic asset allocation. They have gradual shift that is from equity to debt. They have multi-asset investing. These funds may invest in equity, debt, gold ETFs, REITs, and other permitted assets. The key feature is the allocation changes automatically. The investor does not need to rebalance manually. For a country where many investors are new to markets, this structure can be very helpful. Now the important question, what happens to the old funds? SEBI has said that solution-oriented category will be discontinued. This does not mean that your money will disappear. Existing schemes may continue with change, or be merged or be reclassified. Investors will be informed before any change, and exit options will be given if required. So there is no need to panic, but as investor, you need to be aware because the structure of funds may change anytime in future. One critical question investors may ask is, how will life cycle fund affect returns? In the early years, when the fund has higher allocation to equity, returns may be similar to equity-oriented mutual fund. As the investment moves closer to the target year, the fund will gradually shift towards debt and safer assets. Because of this, the potential return in later years may be lower compared to pure equity funds, but the risk is always expected to reduce. The idea behind the structure is not to maximize returns at all times, but to make investment more suitable for the time left to achieve the goal. This is exactly the purpose of life cycle fund, that is to adjust risk and return as the goal approaches near. Most investors make one common mistake. They start investing as per goal, but they do not change strategy with time. People keep high equity exposure even when they near retirement. And when market falls, they panic. Life cycle funds tries to solve this problem. They make investing more goal-based. So as an investor, what should you do? First of all, do not panic with this new rule change. Your current funds will continue. Second, understand your goal. If you're investing for retirement, child education, or long-term wealth, then you should start thinking in terms of asset allocation and not just fund selection. Third is watch for new funds. Mutual fund companies will start launching life cycle funds, and investors should compare them carefully before investing. Not every new fund is automatically better. Choose investments based on your goal, risk appetite, and time horizon. This change shows something very important, that Indian investing culture is changing. Earlier, investors focused on returns. Now the focus is shifting to planning, from product-based investing to goal-based investing, from chasing performance to managing risk. The introduction of life cycle funds may look like a small rule change, but it can shape how Indians invest for next generation. And as investors, we should be aware and we should understand these changes early. Because in investing, the investors who understand rules first usually benefits. If you want more videos about finance, economy, investing, mutual funds in simple yet serious way, then please do subscribe to our channel, like this video, share it among your friends, and be very cautious and wise with your money. It is your money, invest it smartly.